We're going live here. All right, we are live. And so there's a 15-second delay, Raphael, when we talk, and it's actually on YouTube. So I don't know if you're tracking, but you can see it on your phone or whatever. We'll give 1 or 2 seconds here. So before we get started, we're going to go over some disclosures. Again, Raphael and myself, we haven't taken your accounts and your specific account into mind when we created this content. This is strictly educational purposes, no advice, no client relationship has been entered into. What else do you want to say, Raphael, for covering our butts on compliance?
Sure. I mean, exactly what you said. We can't really give any specific guidance to your situation without understanding the entirety of it, which would mean some sort of relationship has to begin. So just meant to be educational in nature, and hopefully there's some benefit that anyone out there listening can get from this.
Yeah, awesome. And I think the other thing that we should say is that, hold on, I'm trying to get my screen right size. The other thing we should say is that today we're talking about taxes, right? It says the top 5 tips to minimize taxes on investments. But we are not CPAs, we're not enrolled agents. And so, keep this in mind. We're not giving tax advice. We're just giving some education. So we're going to go through all 5 of these, and I think these are going to be really important. So when you're in the accumulation stage, you have to think that your income level is at the high your ordinary income, your ordinary taxable income is a high, right? So when we look at this, we're using that lens to kind of go through some of this stuff. So number one, currently the maximum for ordinary income is 37%. And when you have investments and you take a short-term capital gain, you're being taxed at 37%. And then on top of that, you have your state taxes, right? So this is federal, and then there's also state. If you take gains and it's longer than 1 year, then you'll get long-term capital gains rate. And that can range from 0% to 15 to 20%. And some individuals that have a really high income and you have stock options that are coming through that are vesting, you may have an additional surcharge of 3.8%. So the main concept here is that if you have investments that are, I don't know, we use 60 days at our firm. Raphael, what do you use where you decide to take short-term versus long-term capital gains?
It really varies case by case. Most people, I think maybe we'll talk about this later, but understanding the purpose for each account and the timeline that you have, it kind of helps you to understand when you're rebalancing and all of that. So it really varies account by account, but super important to understand the difference between the two.
Yeah, and so for taxable accounts, if you're 60 days away, then we'll either use some options or some way to lock in some of that gain, but give you those 2 extra months so that gain becomes long-term capital gain. But if it's less than 60 days, or if it's more than 60 days, then we're probably taking the short-term capital gain, because we don't, a lot can happen over 2 months. So the key point here is understanding the timing of returns to take advantage of long-term capital gains. So if you're in that 60-day window, you definitely want to push it out to long-term capital gains, right? It's almost a 40% savings. The next one here is understanding turnover, right? So turnover is a big piece, especially for individuals that have separately managed accounts or mutual funds, right? In 2019, the average mutual fund for like a domestic large cap fund had a turnover of 63%. You may want to use index funds or individual securities and buy a basket of them, because you'll get more tax efficiency that way. So the average ETF, which is called an exchange traded fund, had a turnover of 25%, meaning that that's less transactions that actually happen in an ETF, and therefore the pass through of those capital gains is less to you, and you have more control. Another thing in a mutual fund, specifically in fixed income, there may be investments that were bought 10, 15 years ago that they're held on to, like these bonds, so that you can get a higher yielding coupon in this type of environment. But when you have volatility, those are those investments that those portfolio managers are looking to sell to create that liquidity. If there's a draw on cash through a mutual fund, then the only thing they can sell is the good stuff. And so they'll be looking to sell some of the higher paying bonds, which, inbuilt may have a capital gain. So all that to say, your portfolio may have seen a loss, but you still could potentially get a capital gain tax treatment at the end of the year.
Yeah, and I think it's important, Amar, that a lot of people understand that this is happening within these accounts. You think about investments and taxes, and you really only think about when it affects you and not necessarily within the account. These things happen specifically with mutual funds as the investment manager is making changes to the allocation. So important to keep these things in mind.
Yeah, absolutely. Right. And so like, even if you have a mutual fund like Fidelity, Magellan, or something like that, and you're doing buy and hold, you still have tax, turnover there. So the next thing that we wanted to talk about is utilizing lot-specific accounting, right? So now Fidelity, Schwab, TD Ameritrade, all the brokerages, they use what's called average cost basis by default. It's the easiest way to track the tax basis, as well as making sure that the tax reports are simple and easy to read. But we're here to say that if you're in a higher tax bracket and you want to be more tax efficient, you probably want to do lot basis. And with lot basis, you're keeping track of each individual purchase as a separate line item, instead of averaging all the purchases together to get an average cost basis. And this can do a lot in terms of managing your tax situation. You can potentially have one position that you've bought in over a period of time where you have some lots that have a loss, a capital loss, and some that have a capital gain, right? And if you're selling some to create liquidity, well, if you're in a high tax bracket, you probably want to sell the ones that have losses, not the ones that have gains. And so by able to control that, you have to change your tax recording method at your custodian to lot basis. And, this could change a lot of things. Because remember, average cost basis is the average, so you'll have some lots that are higher and some that are lower. So if you're gifting to like a donor advised fund, or if you're trying to make the most charitable impact, you probably want to get the ones with the large gains off the table, right? Which should be higher than the average cost basis. And if you're trying to rebalance or sell, you probably want to get the lower cost basis off the table and defer some more of those gains to later in life. Raphael, you have anything else to add?
No, I mean, I think you said it perfectly. Understand, what's going on in these accounts, which ones have losses, which ones have gains, and strategize with your advisor around that based off of whatever you need to do, a liquidity event, charitable giving, whatever it is. So
yeah, and so let's go to the next one here. And this is I think this is a big one for me. Because I used to work for a big firm, and we had, let's just say, 5 risk tolerances: conservative, moderate, moderately aggressive, and aggressive. And they would put all the shares, all the strategies in every single account. So for example, if you have husband and wife and they had 2 IRAs, a Roth IRA, and a taxable account, and they wanted to be moderate, in those 4 accounts, each account would be a moderate account, and they would all own the same holdings, which is not the best way to do this. And what we're talking about here is each account structure has a different tax treatment. So Roth IRA taxes differently than an IRA, which is taxes differently than a taxable account. So what you hold where is probably more important and managing your overall risk tolerance, being moderate, and then figuring out where to put the pieces of the pie within these accounts. Now, it's not going to be perfect because your Roth IRA may be really small and your IRA may be really big. Your taxable account may be really big and you may have no IRA or Roth IRA, right? So it's different for everybody. But the main concept here is that your big growth-based investments should be in the Roth. Your buy and hold, like most people will own some portion of the S&P 500 in their portfolio. That should be in the taxable account. You want to get long-term capital gains treatment whenever you do sell. And the things that have high turnover, they should be in the IRA. So it's kind of like whatever's left over gets shoved into the IRA. Or if you have bonds, right? If you have bonds and you're generating income, you want those to be in the IRA as well. So incorporating a strategy that looks at your accounts holistically, or your portfolio, which is all the summation of all your accounts, looking at it holistically, and then implementation based on which account has what, is probably a bet. You could save yourself a couple of $1,000s a year in taxes just by doing that correctly. Do you have anything to add to that?
Yeah, I mean, I think this is one of those things that a lot of people don't really know. You hear the terms asset allocation, but I think this speaks more to the asset location. So where are you putting each one of those securities in these types of accounts? So it's really important to first understand what's going on with the tax treatment of these accounts. What benefits do they get? What's the difference between the taxable bucket, a pre-tax IRA, or a Roth IRA? And at that point, you can understand why some of these strategies are better for these accounts. So I think this is a great tip that is probably most often underlooked by a lot of people.
Yeah, most
or at least not
underutilized,
understood.
right? And the thing about it is that most of these big firms, they don't talk about this because you can't scale a business this way, right? Like, can you imagine like Fidelity or Schwab having a strategy that goes over all clients' accounts and articulating that way? That would be very difficult for them to manage because the person that's managing the investments or the model is not the advisor, right? It's somebody in a different office that only has a view of that account, not like the holistic view. And so most of the times when we come across clients that are, or prospective clients that are transitioning over, one of the things that they don't realize is that they have the same holdings in all their accounts. Just cracks me up. But the next one here is to know when to use tax loss harvesting. And this one every single advisor has a different opinion. And maybe Raphael, you and I maybe have a different opinion. But when I hear like companies like Betterment that does daily tax loss harvesting, I shake my head. And the reason is when you do tax loss harvesting, you're reducing your cost basis into a security. You're still holding the same asset class, but you're reducing your cost basis. That's how you get the tax loss on taxes. But once you reduce it, eventually that security is going to come back up. And now you've increased the amount of gains that you're going to be paying taxes on in that one holding, right? So I like to say with tax loss harvesting, you have to be year specific. You're selling a rental property and you have all these gains. This is a year to take tax losses on investments. You have high capital gains with something else. Take tax losses in this year. And vice versa, if you have low capital gains in 1 year and you know where the thresholds are, maybe this is a year to take some gains to reset your cost basis, right? So this slide should really read, know when to use your tax loss harvesting or tax gains, right? Because it can go both ways. Do you want to add anything to this?
Right. I mean, I agree exactly with what you're saying. It's kind of hard to see things on a day-to-day basis with that example used of those robo-advisor platforms that do things on the daily. It's kind of hard to understand whether or not that's going to be the best decision for you come tax time or when it's time to file your returns. Was that the right strategy? It's hard to tell. So I think the approach that you have is something that I agree with. I think it is important to look at it through that lens of what are the situations that are happening to you in each year. COVID was a great example. A lot of people lost their income. If you are now in a lower tax bracket, your long-term capital gains rates is much lower. Maybe it's time to, execute that tax gain harvesting and pay lower taxes on that, right?
Absolutely.
Whereas in other years, it might not have made sense. So
Yeah, absolutely. And one other thing that we should add to this is that you should be looking at this throughout the year, not just like in November, December, right before the year end, right? I mean, a lot of us focus on it in those time periods just because that's where we know what all the other variables are, right? But if you have a crisis like COVID, right, and the markets are dropping, right? I mean, that could be a time where you're like, all right, we can take some losses, or instead of losses, let's consider doing Roth conversions. Take some money from the IRA bucket where the shares are down in value, convert it to a Roth IRA, and then hopefully it bounces back up like things did during this last 18, or not even 18 months. Let's just say last year. And
it's been an eternity.
Yeah, I can't even. I don't remember. So, this is our contact information here. We'll also put it in the notes below. But what I want to do is, if you have questions or any ideas, please put it in the comments. We're new to this. We're trying to learn as we go. So, if you have any ideas for videos, we much appreciate that. I can share some comments here, Raphael. So, thank you for another live event. I'm dusting off some cold nerves and trying to do more live events. So hopefully, Raphael, you'll join me more often here as we go in the future.
This has been a pretty fun process here.
So Ron here asks, so can you control what shares you sell with loss basis? Yes, that is the whole point. And maybe, Raphael, we should do a video on the different share allocations. So like you can do, for example, you look at your trading software and it says, all right, I want this. Not even, there's computer modules computer programs that run in the background. So you don't even have to select the shares. You could say to Fidelity or Schwab or whoever, say, I want the highest cost long-term capital gains only. And it'll bring up all the lots that utilize that. So like look at all the lots that you have. It'll stack rank them from highest cost to lowest cost. So you have the least capital gains to highest capital gains, and then you can select the ones that you want. And it would only show you long-term capital gains. So there's a lot of control that you can have when you're trading with lot basis. Different strategies for each, Roth IRA. I think that's good. And yes, I'm guilty of having the same. I think a lot of us are. Ron, the tricky part of this is that you will, and I say will because I've seen this happen 1,000 times, will most likely get tripped up with the wash sale rules, right? So when you have the same security in different accounts and you're trading it, it's the easiest way to trip the wash sale rules. So just be aware of that.
Right. And Amar, can you maybe elaborate a little bit more on what that wash sale rule is? I think it's important that people understand what it means.
Yeah, so the wash sale rule is really, let's say you're trying to get a loss and you re-enter to security before that 30 days, you eliminate that loss that you were trying to create from a tax perspective. And you have to invest in a like security, and how the IRS defines like is that at least it has to be 30% different, meaning 70% can be similar stuff, but you have to have 30% that's non-similar. And then sometimes that's hard to do because there are a lot of Russell 1000 versus the NASDAQ. There's a lot of crossover there in tech, for example. Thank you, Dr. Horton. Trying to expand with Raphael's been on the podcast here. We recently got the Alex to be on our podcast, Kyle. So what we're trying to do is maybe I'm going to take a stab at this. Is that maybe we do these more on a regular basis, right, Raphael, and we can do them at the same time. So then whoever wants to join can join, and it's something that's consistent.
Yeah, I mean, we're really just trying to put out good information to everybody here. So, and I think it's important to have variety of topics, which I commend you, Amar, for trying to get that here in this podcast.
Thanks. All right, and I'm just learning the software too. Beyond doing this YouTube, we have a full-time client base, and we're trying to do our day-to-day. So this is a venture for us, if you will. Okay, I'm in the process of moving my 401k to an IRA. Not sure if I should do an NUA or not. And that's a good question. Are the NUA calculators out there accurate? You want to take a stab at this?
I'd be wary of using any online calculators out there for net unrealized appreciation. I think that's a very tax-specific situation that you should consult your advisor with. So I don't know that using the online things is the right way to go. It really just depends on what we're looking at. And again, we can't advise on your specific situation, Nancy. Yeah. But
so what I would say is that your custodian that's holding the 401k administrator and the custodian that's holding it should give you a printout of your cost basis and those shares and the gains, right? And then you can use that to kind of calculate, with a legal pad and a pen to figure out, if you end up ahead by paying long-term capital gains on those shares after the initial hit of that on the cost basis. The one thing I would say out there as well with NUA is you don't have to do all of it. You can do part of it. You don't have to do, that's a big misnomer. Some people think you have to do all the NUA as much as possible. You don't have to. Work with a professional, work with the CPA, and make sure that you dial that in. I think it would be good. Yeah, so let's assume you're in retirement there, Ron, and and I did a video about this. You can look it up. It's with the CPA named Kyle, where we went over the three or four things that you want to look at. But just off the top of my head, when I look at doing a Roth conversion, is there a significant other, like spouse, right? Because the time horizon is longer when you have somebody else in the picture, right? Is there children in the picture? Like, are these assets eventually going to children down the road? What tax bracket are the children in? Sometimes you'll find a Roth conversion doesn't make sense because your children will be in a lower tax bracket than you are, eventually at some point. And so those are the big picture things that I look at. The other things is, what is your modified adjusted gross income, MAGI? What is your total taxable income, right? So the reason is total taxable income, you don't want to push yourself into the next tax bracket. Now remember, capital gains and that doesn't count into this. So we're looking at ordinary income tax brackets. And then modified adjusted gross income is really specific to Medicare, right? And so Medicare is the big piece that we're trying to, it's Medicare Part B. There's a IRMA, so your premiums for Medicare Part B increase as you have more modified adjusted gross income. We want to stay on the lower bounds of that and make sure that that is,
I would add also that while Medicare Part B, I think, is one of the biggest reasons to really look at that carefully. If you are at Social Security age, taxation of those benefits could be impacted also, up to 85%, I believe, of those benefits. So
Yeah.
a lot of things to consider when you're paying additional ordinary income taxes in retirement.
Yeah. And, Dr. Horn just put, big picture. Yeah, look, you can only do four things with your money, right? You can spend it, right? So you spend it, it's your hard earned money. We work really hard with clients to kind of connect what's important to them to financial experiences that they want or experiences in life and kind of make that spending actually happen. You can give it to your children, you can give it to charities, or you can pay taxes, right? And most people, it's a combination of the four. But if you have a strong feeling of one or the other, that's going to sway whether you do Roth conversions or not, right? Because if you're going to spend it and spend it down, then probably Roth conversions probably doesn't make much sense, right? Because you can spend it now. So we kind of went over this, Kim. Again, same like Ron. Net unrealized appreciation is the acronym for NUA. And basically, if you have company stock, and it's stock, it's not like shares of a mutual fund, it has to be stock, that the stock you have a cost basis in, there's a way to take that cost basis out as ordinary income and then get long-term capital gains treatment for those assets after. So it's something to make sure you keep in mind. Forget the children, spend to the end. They have their whole life to earn and spend. Yeah, surprisingly, this is a hot debate even between spouses, right? Some spouses, want to make sure that there's a legacy component, and some spouses say, like, we worked hard for this money, or our kids are, they're set up on the right footing. We made sure we did that, paid for college, whatever, and they're successful. So let's spend all this money. I always had that vision of I don't know who did this commercial. I think it was in the early 2000s, where there's this like boat that's going down and it says college fund on it or something like that. So I guess it's different for different people. Making sure you have a cash reserve, keeping tax brackets low. I mean, so for the healthcare piece. But for some people, it's unavoidable that they won't be in the 12% tax bracket. If you just think about Social Security plus RMD, now that's even though it's pushed out to 72, but for some people, that dollar amount will push them out of that 12% tax bracket. Let's see here. Do you have any? We're almost exactly at a half an hour. Do you have any closing thoughts, Raphael?
I just say, I mean, there's so much to tax planning in general, not just with investments, which was what this slide, this presentation was mostly about, but taxes as you are accumulating, as you're distributing, within the investments. There's just so much out there that it's important to not take advice from a one-page article online. Reach out to a financial professional and let them understand your situation and make sure that they truly understand it so that you feel confident moving forward on whatever strategy you execute.
Awesome. Yeah, I appreciate it. If you guys have any questions or comments, please leave it in the section below. Both Raphael and myself do an active job of reading those comments. And if you like this live stream, please hit like so if other people who are just like you can find our content. That really helps us out. And until next time.
See ya.
Bye.